Afternoon, this is Trey with BuildIdaho.com. I got a question for you. What if you're trying to time the market as to when you're going to buy a home? And the things you need to know about are price of the home and interest rates. And you're trying to figure out when the best time is. So let's talk about when to buy, because if the home prices are going to drop a little bit and the interest rates are going to go up a little bit, when do you buy? Okay, this is Leigh with Idaho Banking Company. So Eric, I imagine one of the things that you hear a lot about right now is timing the market. So please explain how the timing the market issue works for you.
We have a lot of customers that come to us and they obviously want to buy their new home at the best price possible. And by that they mean, when is the bottom of the market going to come? We kind of operate under the opinion that if you're able to time the market, you're pretty lucky. It's kind of dumb luck and able to do that. It just is not very easy to do.
Because the only way you know is if you look backwards.
If you look backwards and you see the bottom and you're on the way back up, you know you missed the bottom.
Yeah.
Exactly. So we try to get our customers as close to the bottom as possible because historically that's still very good. But in terms of waiting to buy a house at the very bottom of the market, you're also introducing other levels of risk to the equation. So everybody wants to buy for the cheapest price possible. I would argue right now that the Treasure Valley's housing market has not bottomed yet. The problem that you run into by waiting for the bottom of the market is you expose yourself to interest rate fluctuation. 2.5 weeks ago, my average interest rate on a 30-year fixed for top-tier credit borrowers was 4.875%. Now it's up to about 5 3/8 and has been as high as 5.5%. Why? Simply because of the investment strategies with the big pockets on Wall Street. They're moving money from stocks to bonds, bonds to stocks, and that transfer of money back and forth makes rates go up and down very quickly. So if you wait to buy at the bottom of the market, you also open yourself up to the chance that rates may rise. So if you're pre-qualified or pre-approved, and I always talk about customers, where is the maximum that they can get approved to purchase at? Let's just say it's $250,000 today at 5% interest. Well, what happens if the rate goes up to 6%? You are not qualified, obviously, at $250,000 anymore. It could actually be down as low as $200,000 because of that simple 1% increase in the mortgage rate and comparing that to your previous debt-to-income ratio.
So as a mortgage guy, you're actually more concerned with the interest rate because the interest rate determines your buying power more than the price of the home.
It's some of both, but both need to be given equal weight. If you just look at simply the price of the home, but completely ignore the fact that the higher interest rate has on your debt-to-income ratio, you're missing a big part of it because you may lose your qualification.
Perfect. Thank you, Eric. We appreciate your time today. We hope you got some good advice from Eric. If you have any questions, you can contact Eric at
947-5577, or you can email me at eric@ericsloans.com.
Thank you, Eric.